All right, let's get this thing started. Welcome to 20-minute Annuity Tuesdays. My name's Trent Zimmermann. I'm the Annuities Director here at BGA Insurance. My bachelor's is with a focus of economics. I have a master's in finance. I'm also a chartered financial consultant and chartered uh, life insurance underwriter. BGA is a top GA working with independent agents on life insurance, annuities, long-term care, and disability. And this week, as chosen by all of you, we're talking about the best income annuities. Now, I get a lot of phone calls every day, emails, and it comes down to having two different approaches that I see advisors take when they're contacting me about an annuity case. One is some variation of I have a client, they ask for annuity, how much income can I get for X dollars? Or even simpler than this, what's the best income annuity? This is always followed up by a phone call asking what are the client's goals, how long are we looking to defer, what's their demographic, uh, and it's I'm not always certain that these are going to end up in a sale. And sometimes they're very experienced advisors who know what they're doing and know what the client needs at that moment, and all they're looking for is just a few numbers. But I know it's going to close when I get an email or a phone call like this. I have a client, female, who's 60 years old, living in California, looking to retire at age 67. The goal is guarantee X amount of income, generate guaranteed income from qualified money of X amount, qualified money being retirement funds, or provide longevity insurance with X amount of qualified funds. What are the options? Signed certified closer. When I have these two calls in a day, I know which one is going to close. I know which one is going to lead to follow-ups. I know which one is going to lead to cases being placed. And that's because they're addressing what retirees actually fear. Retirees fear running out of money, a long-term care event, the weight of required minimum distributions on their portfolio, having money left over to bequest to their heirs, and inflationary pressure. But what they fear doesn't match up with what they actually do. Retirees, by and large, panic and sell low and buy back high. They take inappropriate amounts of risk. They plan late or not at all, and they mismatch their spending with their goals. Now, what I'm about to show you is a software that we use. I'm sure you all have similar ones that go through the likelihood of a portfolio to last through retirement. Now, the difference with ours is being in the insurance industry, we also have the ability to put in with or without annuities, and you're able to see the possibility of it being sustained, and also the effects here of the portfolio size with and without that annuity. And what we found working with these advisors that do a great job planning in a holistic way of retirement is there's a number. And there's a number that you annuitize in your portfolio where the client will never outlive their money. Their core expenses will be covered. The chance in a Monte Carlo analysis of portfolio depletion is less than 1%. If you don't know what Monte Carlo analysis is, it's running 10,000 simulations on that portfolio to see what the effects will be in different market conditions. You can look into those and Google them on your own, but they're powerful tools to see the effects of what how robust a plan is. And in over 75% of historical back tests, uh, the portfolio is actually larger at point of death, a larger terminal portfolio size when they have an annuity, and you eliminate core concerns. Now, why is that? Assets under management, you have unknown growth and loss, and the safe income payout is 4%. With an annuity, you have guaranteed growth for a certain period of time in that income roll-up of 6 to 12% usually. There's some higher, some lower, and guaranteed payout usually between 7 and 8.5%. Now, every company works their math differently, so you might see guaranteed payout higher, but this is the typical design for income annuities, which leaves assets under management or AUM fearing two major things: sequence of return and RMD pressures, required minimum distributions. So in this case, we have Mr. Red and Mr. Green. Mr. Red in both scenarios has a poor sequence of return in the start of their portfolio in retirement. And in 1998 to 2024, uh, Mr. Red still has a robust portfolio of over $2 million. It's half what it would be for Mr. Green, but still robust. Now, in 2000 to 2024, you see they're getting close to depleting this portfolio with half a million left at age 85. But this doesn't include RMD pressures. With required minimum distributions at age 75, you're now required to pull more out of your retirement portfolio than what we said that safe withdrawal provision is of 4%. After age 75, it's increasing above 4%, putting your portfolio at more and more risk if you don't do anything about it to convert it to, Roth IRA. So at the end of the day, it takes two. You do not want to annuitize all your income. You do not want to annuitize all your assets. Uh, you would then be losing out on all the upside you can see in the market. You're losing out on some inflationary hedges, and you're losing out on uh, funding that you can dip into in case of emergency, in case you do well that year and you want to take it in travel or spend it on your heirs, or if there is a change in your medical situation and you need to pull more out your portfolio. You lose flexibility, and you lose that terminal size at death. So it takes two. And that annuity will take less money to create the same amount of income, preserving more that you can retain in assets under management, undergo less hedging, which means you're going to have a higher return, stay in the market for a longer period of time, so you're less susceptible to the ups and downs of the market, and you're never going to be taking double downs, which is withdrawing in down years. Now, we all know if you were to lose 50% in a year, you do not need to make 50% to get back up to be whole. You need to now make 100%. Now, what if you're compounding that with withdrawals? That number continues to grow. So you're never going to be in that double down scenario with both assets under management and annuitized income. But what is that number? Now we can be technical. We can find the number for each client where their portfolio is illustrated to have the maximum uh, delta of gain between no annuitized income and taking an annuity. But you're going to spend your life doing that. And really, because it depends on a lot of factors of what are the current rates, the age, gender of the client, and also marital status, and if they're looking to do joint or solo income, the deferral period, the income needed, portfolio size, and then their client's risk tolerance and their anxiety. So this number is never set in stone, and it's always in flux. So you can be the advisor who says, in this illustration, I can create the highest terminal portfolio size for you by annuitizing some of your income, but that's not where the greatest advisors are getting these sales. They're balancing income maximization with longevity insurance, death benefit, inflation risk, long-term care, and offsetting RMDs or required minimum distributions. They're taking care of all these other worries that the clients have with these annuities. And very often, it's these that are the movers, not so much income maximization. If you were to sit down with the client and say, does $100 a year break the bank for you? Do you need that $100 a year coming from your annuity, or would you rather have something that has an inflationary protection or have some long-term care built in, or better offsets required minimum distributions? Most of the time they're taking the one that has a little bit less in that yearly income because they know they can offset that with assets under management in order to get benefits that are worth more to them. So what are we looking for in each of these situations? For longevity insurance, we're looking for long roll-ups, low fee drag, withdrawal flexibility in case there is an emergency before they need to take this, and require minimum distribution offsets. So we're looking for something that can grow guaranteed for a long period of time, usually. Sometimes you might want some non-guaranteed income here as well. And we're looking at something where the fee isn't putting a large amount of drag. Now, there's a lot of ways annuities can design fees, and what we don't want is something built on the annuity value that is going to uh, put a large drag on the accumulation value and therefore affect the end amount of withdrawals or income that this individual can take, whether or not they need this. If they're looking for death benefits, you want that high cap and par rate, and you want a low payout factor. You do not want that 9-10% payout factor. You want to preserve as much as possible of that accumulation value. And you're looking for, once again, a favorable fee structure. Whereas if you were looking at just income maximization, that fee structure doesn't matter to you. You're looking for what can pump out the most amount of income today. And you don't really care about those cap and par rates. You're worrying more about that roll-up rate. Inflation, you want to look at increasing income. Now, I'm going to hedge a little here because increasing income, by and large, is not a good play. The guaranteed increasing incomes never really pay more than the flat incomes, and you don't make more over life, and they'll end at a certain point. And the non-guaranteed, you have to be very careful about the companies that you choose, because some of them have honored those renewal rates and kept them going, and we've had favorable experiences. Others have had a bad history with renewal rates, and then why did you put them in that product and start them off at a lower rate, knowing that they're now never going to reach higher than if they took flat? So it's a careful balance there. The more secure way of doing it is laddering income over time and having different policies start on different dates. And long-term care, now, if they don't have a plan in place, income doublers are a really strong way to be able to cover someone without any medical review of being able to double their income if they can't perform 2 out of the 6 uh, activities of daily living. Now, I put in here favorable terms because all of them run similarly. They're all 5 to 6 years while there's cash value. But that while there's cash value is the hinge. Some of them will say until it's zero. Some of them will say we'll continue to pay as long as there's a dollar in the account. Some will say the cash value needs to be greater than the income payment. And because of that, you need something that maintains cash value. You can have something that looks really good, but only has cash value for about 8 years, and you need to file for that income doubling immediately, which is tough if you're using it for income and the double as a benefit. Better if you're using this as longevity insurance with a long-term care benefit. If they already have a plan in place, this might be lesser so, but they still might be worried about that risk and wanting to put some extra money aside. So maybe these things fall lower. And required minimum distribution offset. This is the opposite of what we've been talking about here. We want cash value depletion. We do not want to maintain cash value in these products. And so you might actually be looking at full annuitization with a single premium, immediate or deferred annuity. Or you might be even looking at tax preferred vehicles like QLACs. Now, how do you get to this place where you're deciding and weighing these options? Uh, we have really excellent annuity producers that we work with that are going through a fact-finding mission with their clients in order to figure out what their needs are. I've spoken to many and distilled down into what many of them are asking. This is not verbatim, but these are good questions to be asking your clients. And so I would encourage you to take a screenshot of this. If you want, I can send this to you. But we also do, from one of our top annuity producers, have a white labeled version of their fact finder. So if you're looking at this and you're saying, all I've been doing previously is looking for what has the highest payout, and I haven't been answering these other questions, I don't know what else is in their portfolio, and you want to leverage the tools that we have with the software to be able to figure out what might be the best range for them to annuitize their income, give me a call, shoot me an email. My information's here. We'll get you the fact finder. I'll get you the information you need that you can send back to us, and we can run through a retirement scenario analysis and be able to figure out what the best amount of their portfolio would be to annuitize and address the other risks that they may be worried about. So again, I'll put this on the screen here for the questions you should be asking, and it's all about uh, what's their baseline level of income needed? If markets are down, how are they going to react? If the markets drop 20% tomorrow, what would they do? Um, what part of their retirement plan are most exposed to inflation? Do they have a long-term care plan in place? Um, and how important is bequesting to their heirs? Uh, and which of those goals would be first to go, which would be last? And if you could guarantee income for life, what would they trade for a little bit less? Would they trade more for more protection, flexibility, or legacy to have a little bit less in income? So take a photo of these, call me, email me if you want the fact finder. My information is here. And now, just like last week, we are going to launch a poll for what you want to see next week with our topic. Go ahead and vote in there. And while we're doing that, uh, are there any questions on what I just described? You can throw them in the chat or you can unmute and join in. It looks like income doublers most likely. All right, we're tied for laddering income and income doublers. Let's do income doublers next week, and I'll follow up with income laddering the next week. That makes it easy for me to plan 2 weeks ahead. And with that, that's your 20 minutes. If you have any questions, feel free to stay on or give me a call, shoot me an email. And once again, reach out to me if you want that fact finder for your clients. Thank you all.